González Mac Dowell, meaning my father was González and my mother was McDowell. Okay, thank you. I'm going to go through the presentation probably through a different angle than some of you were expecting. So basically, EU regulations and the EU regulatory roadmap is public, so it doesn't make sense that I go through it here. But I'm going to give you my particular view, and for that purpose, I'm going to introduce myself. That will give you some context where I come from. I'm going to drive you through the prehistory of what's being regulated now, through the main regulations so far, the lessons learned, and what's coming in the future. So, for starters, I'm not an association guy. I've been working since 1989 in the intersection of financial services, technology, and innovation. The latter part in startups, I was the founder of Eurobits, which was the first account information services provider in Europe back in 2003, long before anybody used the term fintech. So I'm more professional / entrepreneur than I am an association guy, although I sit in many different institutions. I'm a board member of the EPC, European Payments Council. I'm a board member of the European Retail Payments Board, vice chair of EDBPA, chair of Spanish FinTech Association, and I co-chair the SPA scheme, which is basically open banking through a scheme with a fair distribution of value and risk. So that's to give you a background. So I have lots of experience in what's happening, what's being regulated, and what's going to be regulated. As a sufferer of the regulation, not as a creator of the regulation. And you're also going to find that I'm going to be a bit cynical at some points. So many people tend to think that open banking and all payment services started with a regulation. That's the case for some services, but that's not the case for others. So in the particular case of open banking, a Spanish bank called Bankinter launched account aggregation services in 2001. That's a long time ago. There was even a position from Banco de España, which is the NCA, the supervisor in Spain, saying that this was fine from a regulatory perspective. Nobody was even thinking about PSD1 at the time. 2003, Eurobits, the first dedicated account aggregation company in Europe, is created by 2 Spanish banks, so not by a couple of pirates, 2 Spanish banks, actually 2 leading Spanish banks. And a little bit later, Sofort, which was the first real payment initiator player in Europe, was born in Germany. But there was a long journey through the desert. So I think both Eurobits and to some extent Sofort were preaching in the desert. So I don't know, depending on what age you have, but around 2003, 2004, any presentation that you delivered relating to anything related to the internet, including electronic payments, you had a slide where you talked about broadband adoption, number of phones, etc. The smartphone was not even invented then. So we needed certain things to happen. And things that happen is large banks like BBVA, which Garanti is part of the BBVA group, launched a massive project which was called Tu Cuentas, which is word playing in Spanish, your accounts and you matter in Spanish, which was portrayed by Forrester Research as what the bank of the future would look like. And if the future is today, they were spot on. Because this is more or less what every bank in Europe is doing currently. At the same time, Trustly, the other large player in the payment initiation space, launched in Sweden in the same year. And this was the key element for all these starting to work out. So if people wouldn't matter polishing pictures like this in Facebook or other social networks. Why would you mind sharing credentials with a trusted company that is going to do your, to allow you to do your banking better? So this was crucial. And in particular, there was an American company that launched around this time, which is Mint. Actually, it was 2006, I believe. They call fresh banking, they called it. So these allowed to gain a lot of traction for these kind of services. And at the time, Mint was sold at what at the time was considered a staggering amount. It was sold for, I think, $180 million to Intuit. Now it would seem like peanuts, but at the time it was seen as a huge amount of money. So this triggered a number of players trying to do the same in Europe. So Fintonic in Spain, Tink in Sweden, Bankin in France, and there were many others. So this started becoming big in Europe, so it had to be regulated. And it was regulated via something which is called the Payment Services Directive, which basically tries to foster competition and innovation in the payment services, subject to a strict level of security. And in theory, one of the aims was to balance innovation and competition on one side and security on the other. And this was materialized via what was after what's called PSD1, which basically regulated two kinds of services, payment institutions, which would allow to issue IBANs without being a credit institution, and to perform credit transfers between those IBANs without being a credit institution. And then an additional figure, which was e-money institutions would, on top of that, were allowed to issue electronic money. So this was a major step forward, but it had several drawbacks, which I'll go through later. And the fact that this didn't achieve the objectives that were pursued brought the reason to have PSD2, which was launched a number of years later. Actually, it's a slide, and you see in the next one, between 2016 and 2019. And these, the major difference between the two directives is that the first one created the possibility of performing those services. The second one regulated something that already existed in the market that I already showed. And this is a lot trickier, because if you want to innovate, you cannot limit what those companies were already doing. And so what was done in PSD2, of course, this is much more complex than what I'm portraying here, but is regulate account information services, which were previously called account aggregation services, and payment initiation services, so pay by bank. But in the case of payment initiation, you're just triggering an account-to-account payment without even getting into the possession of funds. You're virtually logging in the bank as if you were the customer, filling in the payment form and clicking the payment button. As I said, PSD2 was very complex. It was entered into force in 2016, but that meant really nothing because it had an RTS that was very complex, that thanks to EDPPA was rejected originally. Then it had to be rewritten, and then there was a long time before everything entered into force in September 2019. So basically what these meant is that these services that were provided in an unregulated fashion, albeit not illegally, on the grounds of GDPR, the data protection law in the EU, were now regulated. So you had to obtain a license in order to be able to provide those services. And here maybe I'll give you the first cynical hint. So in Spain, there were a number of players, and only Eurobits and another one, Fintonic, were able to obtain a license in time. So the national supervisors were not prepared for these kinds of licensing regime, And many companies found themselves in a situation where they couldn't provide their services legally. They kept doing it, but it was not completely legal. That supervisors overlooked it. The other cynical point is that PSD2 actually hampered innovation. So maybe, I'm not sure if you can see that graphic very well, but those are real data from Eurobits. So the day the RTS entered into force, most of our customers lost their customers in return because the APIs didn't work. The alternative had to face an SCA that was not documented. It was chaos. And then conversion dropped by around 25% across Europe. Not exactly what you would expect from a legislation that, in theory, aimed to foster this. So what did we learn, before going into the future, what did we learn from all this legislation? First is that you need proper incentives. So in the case of PSD2, not so much in the case of PSD1, you can force an industry to share some of the most valuable assets, data assets, so the customer information and transaction assets, being able to perform payments. You can force them to do it for free, but what you can't force them is to do it well. So if you have no incentive to doing it well, it will never work. So that's the first lesson. The second lesson is you need proper governance. So if you're going to supervise innovation and competition, you should make sure that the body that's supervising innovation and competition has innovation and competition in their mandate. Neither the EBA nor the national competent authorities in Europe have a mandate over innovation or competition. In other words, they couldn't care less if there's innovation. So naturally, the combination of no incentives plus the supervisors having also no incentives in forcing the banks on doing things well meant that things were not going to be done well. So not a pretty good combination. Then you need to review legacy legislation. So on top of PSD2, there's a lot of legislation that talks about payments. A lot of that legislation was created before PSD 1 or 2. So I'm going to give you national examples in Spain. So there's national law that says that in order to pay the tax authority, you need to be a credit institution, which made a lot of sense when that piece of legislation was passed because only credit institutions could perform payments. But now it's completely obsolete. Same goes for the clearing and settlement entity in Spain, Iberpay. And what I'm saying about Spain applies to almost every EU country. So you need to be a credit institution to adhere there. So if you're going to change something, you have to change everything that relates to that. Otherwise, it's not going to work. And in particular, in the case of PSD1, if e-money institutions and payment institutions don't have direct access to clearing and settlement, and they have to rely on their competitors to have indirect access, that's never going to work. Most credit institutions that have direct access and can be correspondents to the PIs and EMIs are not prepared to be a technology provider for these institutions. And even if they're prepared, they're really not incentivized to do it because they're going to eat part of their pie. Again, you need to make sure that legislation allows for what your political objectives were that actually materialize. Fourth is that you don't innovate by decree. And I'll dig a bit more about this later. So the legislator is not going to tell you what you have to invent. Otherwise, you invent it. Why would I risk my money if you know better than I do? So you need to create a framework, but that framework has to be very loose, otherwise there's no innovation. And then lastly, what did actually work? In the case of open banking, and I think this is related, I would need a lot more time than I have now to go through this, but I think in a nutshell, my personal belief is that fintech is the best thing that happened to traditional banks in a long time, because it allowed them to be better prepared to fight the real threat, which is the big techs. So banks are now better thanks to fintechs than they were before, but in some way fintechs are the victims of friendly fire, because it is perceived that if you open the door to fintechs, you're not going to selectively close it for big techs. So massive access to data has not worked, and I don't foresee it working in a while, unless there's an incentive regime. What has worked is the discrete access to information. So there are companies doing very well using payment transaction history for onboarding, for IBAN validation, for credit scoring. There's a particular case in Spain which is very successful, Bankinter Consumer Finance. Since they implemented the project of alternatively doing the onboarding via open banking instead of sending pictures of your payroll, your tax declaration and whatnot, it takes 5 minutes. It's much more cost efficient. Fraud has been reduced almost to you being fired after doing the application, and the income has multiplied by 7, and by 3 in 3 consecutive years, and they've come to the level of Banco Santander being a much smaller firm. So that actually worked, but many of the other things didn't. So what the future looks like, and this is to a large extent, my personal impression. So I think that what will drive the future of payments is going to be regulation, but also technology and consumer demand, probably in that order, at least in Europe. But in order for this to work, I think you need this. We need to move from the left to the right. So we need regulation that is easy to interpret, that's thin, that's principle oriented, and looks for concrete outcomes, and that leaves a lot of headspace for the market to innovate. Otherwise, you're creating a big cost of uncertainty. In Europe, we call what people do at Brussels creative ambiguity. So Monday, you have the fintechs pulling you this arm. Tuesday, you have the banks pulling you in the other direction. So what do? You kick the can down the road. You write a paragraph that makes everybody happy, but then when you have to implement it, there's no way to implement it. So I thrive for a concept that I call programmable regulation. I know this is probably a utopia, but if you have these systems, you're a financial institution, you have these systems, and they're legal, and this is the regulation, you should be able to give it to ChatGPT or to a programmer, and he should be able to unequivocally make an evolution of your system to comply with the new regulation. That's not the case. You need to hire a bunch of lawyers. Not even the one that wrote is sure what he meant. You have, I don't know if you're familiar, you have the EBA Q&A tool. In the case of PSD2, when we reached 300 questions, they deleted them and they started from scratch. And every time they give you a reply, it raises 3 additional questions. So that has a lot of cost of uncertainty and hampers innovation. So now I'm going to align what I believe is going to be close to the future of payments in Europe and what pieces of legislation affect it. So first, I think the pillar of payments in Europe is going to be instant payments. I think this is a major revolution that is going to happen very soon. Instant payments means that there's no risk of execution. Payment has to be through in less than 10 seconds. The second one is proximity technologies that would allow to pay in store. And there are two alternatives for that: QR codes and the real good one, NFC. Then mobile proxies. Everybody remembers it's mobile, but most people don't remember their IBAN. So Bizum in Spain has shown that this can be a big success. 27 million customers in a matter of a few years. And so basically, it looks like you pay to a phone, but the phone is only a proxy to a concrete IBAN number. And lastly, before we go to the next slide, schemes. So you need incentives, and the best way to work with incentives is via schemes instead of bilateral contracts between thousands of players. In Europe, we have, I think, 7,000 credit institutions, hundreds of fintechs. So there's no way you, so that, I haven't done the math, but that probably means millions of bilateral contracts. So the best way is to have a single scheme contract. So that's going to be part of the future. And in terms of legislation, instant payments is regulated by the Instant Payments Regulation, which, by the way, changes the settlement finality directive and gives access to payment institutions and to e-money institutions, direct access to clearing and settlement, although it's left to the discretion of the national competent authority, so it could have been done better. In the case of proximity technologies, this is not exactly legislation, but this was fostered by the central bank, and it's being executed by the EPC. The EPC has a QR code standardization initiative that's going on. It applied for an ISO standard, but we made the mistake of not speaking with the Chinese, the Americans, and I don't know who else blocked it. You need to do lots of politics here before you submit a standard. And in the case of NFC, there's something in Europe called the Digital Markets Act, which is a very broad piece of legislation, very interesting, that aims to stop big techs in having the monopoly of what happens in their devices. So you need, it's not only related to payments, you need, in the case of Apple, for instance, you need to allow to have an additional store in your phone, not only the Apple Store. And this is the basis for the EU forcing Apple to open their NFC chip. This is probably going to take a while. Apple's proposal is not good enough. They still keep a competitive advantage, so this probably take 1 or 2 more years to settle, but it's going on. In the terms of mobile proxies, this is uncertain how it will pan out, but what we're fighting for is that mobile proxies count as unique identifiers. So this is one of the tricks of legacy legislation. PSD talks about unique account identifiers and that are issued by the bank. So the bank is not issuing the GSM number, it's the telco. So that can be read as that is not a unique identifier, and thus it cannot be used by TPPs to identify accounts. And that gives traditional banks a competitive advantage. Then in terms of schemes, both PSD3 and FIDA, which goes a bit beyond payments to open finance, include the possibility of having schemes with remuneration models. In the case of PSD3, on top of the mandatory compliance APIs, which, as I said, will never work. Then we will see direct access to CSMs by payment institutions and e-money institutions to make them more competitive. And we are fighting in this regards that this is done fast. So the instant payment regulation is going to start applying January 8 next year. So we don't want the market for instant payment to be full, and then when payment institutions and e-money institutions are able to access directly to CMS, it's too late, okay? And this is being regulated in a transitionary way by the instant payment regulations, but PSD3 also covers it. And lastly, the final word on this will be the settlement finality directive. Instant payment regulations already approved. PSD3 is in the final negotiating stages. It will likely start applying end of 25 or sometime in 26. And the settlement finality directive is around 1 year away. 6 digital euro, which I think is never going to work. Reason being, the central bank made the choice of making the digital euro a currency-based, an account-based currency. And what I've asked this in many places, and nobody has given me an answer. Not even a good answer. They don't have an answer. So how I am, as a citizen, going to tell the difference between a digital euro and a digital euro? And I'm going to tell you an anecdote. So I told you at the beginning that I was the co-chair of SPA. My co-chair for almost 5 years was Christian Schaefer, which worked at Deutsche Bank at the time. And then he moved on to be the scheme manager for the digital euro. And we had dinner at Frankfurt. And I told him, Christian, if they accept digital euros in this restaurant, I'm going to take the bill. So I asked when the waiter came with a point of sale terminal, I asked him, do you accept digital euros? And he said, of course. So there's no way you can make an ordinary citizen understand the difference. And it's better that they don't understand it, because the only way you can make them understand it is, oh, because digital euro is safer because it is backed up by the balance of the central bank. Then what? The money that I've had all my life is not safe? Why can I have all my money backed up by the central bank? So my view, this is never going to work. But this is my personal view. Don't take it as neither the AEFI view or the EDPPA view, although many people in EDPPA would agree. And this is very advanced stages digital euro regulation. By the way, it wouldn't be the first time that a European Central Bank project fails. So as we say in Spain, they're firing with the gunpowder of the king. So they don't have shareholders to respond to. And lastly, open finance, which is the interim stage before open data is being regulated by FIDA, which is also in the final stages of negotiation and will enter into force pretty soon. So ultimately, what this is leading us is to something like this. And this is something we created in the SEPA API days before SPA. So basically, we've evolved from an analog world, and I'm going to illustrate this with an example. You go to a branch, you ask for a credit, you fill in a piece of paper, you sign it, it gets into an envelope, it gets sent to the central offices, somebody goes through it and eventually approves it. It takes a number of days or weeks, and then you get a phone call. Your loan is approved. You go to the branch, you sign it. The stage we're at is that value chain has been digitized. You fill in the form electronically. You hit the enter button, and maybe in a matter of seconds you have the approval. But the value chain is the same. It's only more efficient. So we're moving towards a world where different industries are going to be forced to limit themselves to what they do well, to the Lego bricks that they do well, and you will eventually have situations, and this is not extremely creative, it's probably just the tip of the iceberg, and it's already happening in different places. So you want to buy a car, you go to last slide. You go to a car dealer and you select the car you want, the extras, and the sales rep shows you a tablet. You type in your user ID and password of the bank of your choice, and then in a matter of seconds or minutes, the loan that you requested is approved. Your insurance is approved by the insurance company. You also contact public authorities and you get a registration plate issued, a permit to drive, everything, and in a matter of 5 minutes you're driving out of the car dealer with your car, with everything set up. And as I said, this is not very creative. I'm sure that we will see in the near future value chains that we can't even imagine today. So this is ultimately where we're going, the objective of the legislation. But the problem with the legislation is that typically legislators are a bit too far from reality, and then it's not just the legislator applying the legislation, is that you have a number of other institutions that are not fully aligned with the objective of the legislation. So sometimes it's going to take longer than some of us would hope. You know, change. I don't remember the exact quote, but something like, we tend to overestimate change in the short term and underestimate it in the long term. So this is going to change dramatically in a number of years. So this was what I wanted to present today. In case you have any questions, you want to know more details about legislation, I have a booth somewhere over there. And if you have time, I'm glad to chat with you about it. Thank you very much. And I don't know if there's time for questions. I have no idea. Yes or no? Oh, if anybody has questions. Is there a microphone? Is there a...
Thank you for the presentation. I just want to know if there's going to be any kind of a gold standard for digital money. If there's going to be a gold standard, are you going to back digital currencies with anything?
I don't think so. You mean a gold standard? You mean a global standard?
Before the 1970s, there's like the US dollar was backed by gold, or most currencies were backed by some other kind of tangible. If a currency goes down, you could pay back that to the people. Like, is there any system where you... So
first, this is more a macroeconomic question than it is a payments question. And although I have an economy background, it's too far away in time. But I would tend to think that digital currencies are a reaction to what was perceived as a big threat by Project Libra. That threat is not longer that big. Actually, it's not, Libra is no longer a threat. But some projects, including the euro, already kick-started, and it's very difficult once you start something to say, well, maybe this doesn't make sense, let's forget about it. But there is a legitimate concern for the euro, which is people, at least in Europe, are using cash less and less. So what that means is that there's less control over monetary policy for the central authorities. I don't know if this is the same or to what extent this is a problem in other geographies, but this, to me, would be the only reason that would require to think about a project such as this. But in my view, it would need to be token-based digital currency, because, as I said, if it's account-based, how are you going to tell the difference between one digital euro and one digital euro? And the same would apply for a Turkish lira or whatever account. So why would I pay with this and not with this one? I think it's going to take some time. So this is still in its infancy, and it's going to take some time until different monetary authorities in the world agree on what's going to happen. But I'm a bit distant from the question you're asking, so maybe somebody knowing more than me says, what the hell is this guy saying?
If a bank goes down, some central bank pays off the people that have accounts in the bank. If a digital currency goes down, is there any kind of insurance system or security system where like the European Union will be paying off the people holding the digital currencies?
So you mean backup systems or contingency systems? That's a good question. I mean, we've gone a long way in IT, so that is not a major concern, but shit happens every once in a while, and you have Google going down or WhatsApp going down, and then you have chaos, but typically it's very short-lived. I don't know how that is being taken into account, and no idea. I can try to find out, and if you give me your, I may be able to give you an answer. Not my answer, but somebody else's answer. Any more questions? Thank you very much.